Subscribe to our channel and click on the bell button to receive important financial updates faster than anybody else. Friends, welcome to another video on your channel Profit and Equities. If you like the content, please don't forget to hit the like button. Also subscribe to our channel, click on the bell button and choose all notifications to receive important financial updates from our channel at the earliest. Now, the recent carnage in mid and small cap stocks can be attributed partly to forced selling by mutual funds following the recategorization exercise. In addition to defining large caps as top 100 companies in terms of market capitalization, the Securities and Exchange Board of India insisted that 80% of the portfolio of a large cap scheme should be in these stocks. This hit the mutual fund industry in two ways. Several fund houses treated stocks above Rs 10,000 crore market cap as large caps, but the new definition moved stocks within the Rs 10,000 to 30,000 crore range to the mid cap category. Similarly, companies with market cap below 9,000 crores became small caps. Several large cap fund managers were generating alpha by investing in mid and small cap counters, and that had to stop. Though the rule was notified in 2017, the time given to mutual funds to comply was till June 2018. Since the money involved in the restructuring exercise was a whopping Rs 8 lakh crores, the forced selling created havoc. In this video, we'll be talking about 5 such mid and small cap stocks which were affected by this recategorization exercise and which can be worth buying right now. Please watch this video to know more. Also friends, the link to the source for this video is present in the description section. Please go through it and build more conviction around your investment decision. Now, the first stock on the list is Shova Limited, which is available at Rs 485.35 and the face value for it is 10. The symbol for it is SOBHA. Now, Shova Limited is engaged in the construction and development of residential and commercial projects. The company is also engaged in contractual projects and has completed approximately 390 projects in both real estate and contracts verticals with a total developed area of over 81.64 million square feet. Now, the one-year chart reveals that this stock was on an uptrend for about the first 4-5 months of the year, but since then has been steadily declining in value. Mutual fund holdings in Shova have fallen by 218 basis points. Analysts continue to be bullish on this counter because the current cut is not due to a deterioration in fundamentals. Shova reported a 22% jump in pre-sales during the first quarter of 2018-19. An Axis Capital report says that Shova is expected to report better volume growth in 2018-19, driven by around 8 million square foot of new launches. There are other factors favoring Shova, including industry consolidation due to the implementation of RERA, continued absorption of commercial property, and the resultant job creation in its base, which is Bengaluru. Now, if you were to look at the market cap, the company has a market capitalization of 4,603.34 crores, which means that the company is a mid-cap one. The EPS of 20.44 translates into a price to earnings ratio of 23.75, which is below the industry PE of 27.58. The book value stands at 275.93, which translates into a price to book ratio of 1.76, which is also not wildly expensive. The debt to equity here is 0.9943, whereas the return on equity is 0.0801. The company has a dividend yield of 1.44%, whereas the promoter holding stands at a strong number of 55.94%. Now, industry consolidation due to RERA and better pickup in Bengaluru will help this company exponentially going forward. The second stock on the list is Federal Bank Limited, which is available at Rs 87.25 and the face value for it is 2. The symbol for it is FEDERALBNK. Now, the Federal Bank Limited is a banking company. The company operates through 4 segments, which are treasury, corporate or wholesale banking, retail banking, and also has other banking operations. Mutual fund holdings in Federal Bank fell 462 basis points between December 2017 and June 2018. However, its fundamentals remain intact. Despite NPA problems plaguing the banking system, this old generation private sector bank remains strong. The bank reported strong numbers during the first quarter of 2018-19 and was able to maintain its gross and net NPA levels at 3% and 1.7% respectively. Recoveries and upgrades continue to be strong at Rs 250 crores in the first quarter, which indicates that Federal Bank's asset quality may be nursing back to health, is what a JM Financial report has to say. With stable asset quality, Federal Bank will be able to maintain future growth. The management also plans to improve its provision coverage ratio, which is PCR, by utilizing proceeds from the expected stake sale in its insurance subsidiary. Last quarter's street-beating performance can also be attributed to the 22% year-on-year jump in net interest income. Improvement in net interest margin triggered by increase in current and savings accounts ratio to 33.5% from 32.8% quarter-on-quarter, and increase in retail deposits is the main reason for this NII jump. Since the bank relies mostly on retail deposits, which is around 94% of total deposits, analysts feel that the bank will be able to maintain its high net interest margin in the coming quarter as well. Now, if you were to look at the one-year chart, you would see that the stock has not really performed well and has been on a consistent downtrend. The market cap of 17,276.34 crores translates into a market capitalization which can be classified as a mid-cap one. The EPS of 4.70 translates into a price to earnings ratio of 18.56, which is much cheaper when compared with the industry PE of 34.17. The company is also available at a price to book ratio of 1.42, which is also decent. The dividend yield is 1.15%. Now, the third company on the list is Submax Engineering Limited, which is available at Rs 286.20, and the face value for it is 1. The symbol for it is SADBHAV. Now, Submax Engineering Limited is a construction company. The company is engaged in the construction and maintenance of roads and highway, irrigation systems, and others. The company is also engaged in the site preparation for mining, including overburden removal and other developments. Now, the one-year chart reveals that this stock was on a parabolic rise for the initial half of the year, but since then has been on a consistent decline. Mutual fund holdings in Submax Engineering came down by 243 basis points, pulling down its price by 33.17%. However, Submax is heading towards a bumper year of new contracts. This is because NHAI and other agencies are expected to commission around Rs 1 lakh crores of new projects, and most will be awarded before the elections. Submax is well placed to capitalize on these growth opportunities because of its strong cash flow profile. Its debt came down to Rs 1490 crores in March 2018 compared to Rs 1780 crores a year earlier. Analysts are hopeful Submax will be able to reduce its debt by another 200 crores. Now, if you were to look at the numbers, the company is a mid-cap with a market capitalization of 4,910.36 crores. The EPS of 12.86 translates into a price to earnings ratio of 22.26, which is much below the industry PE of 27.58. The company has a book value of 109.67, which translates into a price to book ratio of 2.61, which is also not wildly expensive. The dividend yield percent is 0.26, whereas the promoter holding is just about average at 46.47. Now, the fourth stock on the list is re-categorization Limited, which is available at Rs 365.75, and the face value for it is 2. The symbol for it is WABAG. Now, re-categorization Limited is a holding company engaged in water treatment field. The company's principal activities include design, supply, installation, construction, and operational management of drinking water, wastewater treatment, industrial water treatment, and desalination plants. The company's segments include India and the rest of the world. Now, the one-year chart reveals a very disappointing picture as the company has been on a consistent downtrend. Other than forced mutual fund selling, lower than expected results for 2017 to 18 also contributed to the fall of re-categorization. This leading player in water and waste treatment was expected to report fabulous numbers, and therefore market severely punished it for weak numbers for the fourth quarter of 2017 to 18. However, analysts are hopeful that its domestic business will pick up with projects like Namami Gange, Amrut, etc. Since crude prices are stabilizing, orders from petro companies will also revive. Analysts are hopeful that re-categorization will be able to show a consolidated revenue growth of around 20% during 2018 to 19. Fresh orders expected from Namami Gange and also from global oil majors will be a huge trigger for this stock. Looking at the numbers, the company has a market capitalization of 1,999.23 crores, which means that the stock is a small cap one. The EPS of 21.43 translates into a price to earnings ratio of 17.07, which is much below the industry PE of 31.22. The book value of 167.74 also translates into a price to book ratio of 2.18, which is reasonable. The debt to equity here is 0.4463, whereas the return on equity for this stock is 0.1240. The company has a dividend yield of 1.09%, whereas the promoter holding is a bit disappointing at 24.69%. Now friends, please remember that Porinju Valiath is one of the major shareholders in this company. Now the final stock on the list is Gateway Distriparks Limited, which is available at Rs 178.25 and the face value for it is 10. The symbol for it is GDL. Now Gateway Distriparks Limited is an integrated logistics facilitator. The company's principal business activities include storage and warehousing, which includes general merchandise warehouses and warehousing of furniture, automobiles, gas and oil, chemicals and textiles. It also includes storage of goods in foreign trade zones. Now the 1-year chart shows that this company has been on a consistent decline throughout the year, and a lot of people have lost money in this stock. In addition to mutual fund sell-off, sentiments towards this export-import logistics major has also been impacted by trade war fears. Intermittent rise in India's trade imbalance is another short-term problem. Since Gateway has been able to maintain its market share even during these tough times, analysts believe that its growth phase will come back once there is sustainable recovery in export-import volumes. The stock is fundamentally strong, but investors need to wait for recovery in EXIM volumes. If you were to look at the market cap, the company has a market cap of 1938.08 crores, which means that the company is a small cap one. The EPS of 4.11 translates into a price to earnings ratio of 43.37, which is below the industry PE of 44.24. The book value of 65.79 translates into a price to book ratio of 2.71, which is also not wildly expensive. The company has a strong dividend yield of 3.93%, whereas the promoter holding is a bit on the lower side and stands at 29.57%. Now friends, please don't go ahead and just jump into these stocks. Please conduct your own research. This and all other content that you see on our channel is intended to be pieces of news. Thanks for watching, and if you have not yet subscribed to this channel, please consider doing so.